Hi, I want to welcome you to our next International Economics and Finance lecture. And this time we're going to talk about interest rate parity. In the previous lecture, we were discussing purchasing power parity, and we established that it is one of the main driving forces behind nominal exchange rates. Now we're going to move to short run and medium run, and we're going to discuss how exchange rate depends on the differences in interest rates in different countries. Okay, so what are we going to discuss today? We're going to start with real interest rate that actually provides us with a link between interest rates and prices, which will allow us to create a model that incorporates both of those into exchange rate determination. And we're going to start by discussing covered interest rate parity. Then we're going to move to testing it. Then we will go to uncovered interest rate parity. And again, we're going to move to testing this notion. Then we're going to talk a little about risk premium and transaction costs that actually are responsible for deviation from interest rate parity. Okay, so let's start with a very simple reminder of why do we even use real interest rates. So imagine a situation like this. You have L euros. Let's just say this is a very big amount of money. The nominal interest rate on bonds in euro area is I euro, and the inflation rate in the eurozone is pi euro. So look, in such circumstances, how much money are we going to have if we're going to invest our money in a bond? Well, at the end, we will have L times 1 plus nominal interest rate. But look, of course, when you make investment decision, you should not be interested in how much money are you going to get, but how much goods are you going to be able to purchase with this money. So look, this is how much we can calculate our revenue in real terms. Our revenue in real terms is going to be the amount of money that we had at the very beginning, multiplied by 1 plus I euro, and this same amount now should be divided by 1 plus inflation, because due to inflation we can now purchase less goods, so the amount of money, even though not would be bigger in nominal terms, it doesn't need to be bigger in real terms. Okay, but look, if this is the case, if this is giving us the real amount of money we're going to have, then it means that it implies that somewhere over here there is a hidden real interest rate, R euro. And look, if I'm gonna compare those two to each other, I'm gonna cancel L from both sides of the equation. I'm going to end up with the expression like this, that provides a direct connection between real interest rate, nominal interest rate, and inflation. Okay, but look, from this, if I subtract 1 from both sides, I get direct expression for real interest rate. So it is equal to 1 plus nominal interest rate divided by 1 plus inflation minus 1. Okay, but look, as you probably already noticed, we prefer to use logarithms. And there is another thing there is another thing we should another reason we are using logarithms in here. Look, it happens to be that it's really easy to prove that for small number, when x is, let's just say, below 0.1, So, like interest rate, natural logarithm of 1 plus x is approximately equal to x. So we can say that our approximate real interest rate is simply equal to the difference between interest rates in the euro area and interest rate and inflation in the euro area. Look, let's say over here. Let's look at this over here for one more second. If I logarithmize both sides of this equation, well, all those ones are gonna be gone, right? And due to division here, division is gonna change into a minus. And this is what we see over here. So look, real interest rate is actually measuring how much in terms of goods we made on some investment, because we are making this correction for inflation that is showing to us how much we are losing due to the fact that prices are rising. Okay, so I think this is it about repeating what is real interest rate. Now let's look for a second how it is behaving. Because look, here we have data on Canada between 1917 and 2011. We've got inflation, nominal interest rate, and real interest rate. First of all, we can easily notice that they are relatively volatile. And look, there are there are some very important things that we can see over here. For example, if inflation rate is higher than nominal interest rate, real interest rate can actually be negative, and it happens from time to time. This, of course, might be very problematic for central bankers, but not as much as nominal, like as nominal interest rate reaching zero. But about this a little bit later. And look, we also see that to some extent, real interest rate follows nominal interest rate. And of course, if inflation is low, they are basically around the same value. Uh, uh, Finally, look, if we would have a deflation like you see over here, there isn't even a possibility, or especially like in 2009, that we can have actually real interest rate higher than nominal interest rate. Of course, this is a possibility, but it does not happen very often. We would need to have a deflation, of course, for that. Okay, now, but again, one thing that usually confuses everyone at the beginning of the classes about interest rates is that we've got a lot different interest rates. So which ones are we talking about? Look, interest rate, when we talk about it in macroeconomics or international economics class, usually refers to some abstract average interest rate. Because, of course, interest rate on deposits and on loans are two different values. If they were the same, there would be no profit in collecting money from some people and lending them to some other people. This is how bank works, right? So, of course, those interest rates need to be different. But when we are comparing interest rates, we are comparing simply interest rates on very similar assets. If we are lucky, we could say they are perfect substitutes. And in this case, comparing interest rate is possible. But this tells us two things. First, that assets with the same properties, let's just say it like that, should have similar interest rates, and because those interest rates are moving together over the time, then we can use this one interest rate as an indicator. But the second thing that pops to our mind is, what about the term structure? Term structure is, do we expect uh, interest rates, if I lend you money for 1 month, 3 months, 6 months, and 1 year, to be the same? Well, we don't. Look, liquidity preference is telling us that we prefer to have money sooner than later. So, in general, we expect that interest rates on lower terms uh, are going to be different, and the further we go from a given time point, the higher should be the interest rate. But this brings us to the subject of maturity, because we are gonna talking about bonds. I'm gonna stick to bonds over here. And listen, bond maturity is the time when the bond issuer must repay the original bond value to the bondholder. The maturity date is set when the bond is issued, and the bondholder can sell before this time if they want to. So look, generally speaking, maturity is a time after which the debt must be repaid. So in this case, if we have an issuer of a bond, then if maturity is 3 months, it means that the bond must be repaid by the issuer uh, in 3 months. And now, uh, now that we know that maturity of basically any asset is telling us how much time do we need to have to get our monies back, we can talk about term structure. And term structure of interest rates, commonly known as the yield curve, depicts the interest rates of similar quality bonds at different maturities. So look, again, we are looking only at bonds that are of similar quality. For example, if you have United States bond or German government bond, you are relatively sure that this bond is going to be repaid. So there is very low risk that you're not going to get the money back. Now, if you're going to take some third world country where government is changing very often, or even worse, they have some kind of dictator in power, and you are not trusting the government to repay the money that you are lending them. So in this case, uh, in order to attract people, they need to pay higher interest rates. This is why when we talk about term structure, we need to make comparison. Like the bond needs to be issued by the same organization with this, or organizations with the same reputation. Uh, 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 reputation, and now we are observing the value of interest rates at higher and higher and higher maturity. Okay, now let's look at on the example. Look, over here we see term structures of United Kingdom. Here we see 3 months and 6 months interest rates. As you see, they are actually following each other extremely closely. And here we see the term structure. The term structure is simply the difference between the two interest rates. This is why it's actually measured on the different axis. And look, again we see that liquidity preferences doesn't work all the time. Sometimes we are above zero, which in this case is something that we would expect, because of course, if the 6 month interest rate, as you can clearly see over here, is higher than 3 months interest rate, then we expect here a positive value. But from time to time, we see that actually term structure is turning upside down. And look, we see a very similar situation in Japan. So we also see that actually term structure is changing from positive to negative. Although, in case of Japan, we see something that is even more interesting. Look at those interest rates. We see here that there is actually since the 90s there was a secular trend dwarfing the interest rate, making it extremely small, and for a time period they're being at zero. Yeah, but even in this time, we could see that actually we had positive term structure. Okay, so now that we know how interest rates are working, what is the term structure, what is maturity, what is real interest rate, let's focus now our attention on nominal interest rates only. Because now we want to derive a covered interest rate parity. Okay, so let me start you off with a very simple example, very similar to the one we had before. You have L euros. Let's imagine that this is a big amount of money, and you consider whether to invest it in Eurozone bonds or US Treasury bonds. And now, assuming that I euro is the nominal interest rate on bonds in euros. IUSA is the nominal interest rates on bonds in US. S is a spot exchange rate. So in our case, this is going to be price of $1 expressed in euros. And F is a forward exchange rate. Price of $1 in euros sometimes in the future. For now, this is all we need. Okay, so look, if you decide where to invest, what type of calculations you need to make. Okay, look, you've got this L euro, and first thing you can do is to invest this L amount of this L euros in European bonds. And look, how much will you receive at the very end? You will receive 1 plus interest rate on European bonds times L. And this is, of course, expressed in euros. Now, when the second option you've got is to change your currency, is to invest, of course, in United States Treasury bonds. But to do so, first thing you need to exchange this L euro for L divided by S dollars. Remember, we are dividing here because price of one, because spot exchange rate is defined as price of $1 in terms of euros. So if I divide by S, I now have dollars. And look, what do I do? What do we do next? We invest this amount of money in American bonds, and what do we receive in the end as a result? This amount of money expressed in dollars times 1 plus US interest rate. But of course, look, what we need to do now is that when we're gonna, when this investment is due, we want to receive our euro back. And look, what does it mean? It means that sometime in the future, let's just say 1 year from now or 3 months from now, what we will need is to take the money that we got from purchasing the bond and selling and getting the money repaid with interest and exchange it back for euros. But look, at this moment, we do not know what the exchange rate is going to be. But if we do not know what exchange rate is going to be, it means we can either lose or we can make some additional money. But in a situation like this, the rational agents, if they want to avoid risk, they can do a very simple thing. They can engage in a forward contract. And this is what we do over here. We exchange the amount we made in the United States by multiplying dollars by F, where F is forward, let's just say 3 months or 1 year from now. And then, and only then, what we can do is to compare the two investments. Why? Because they are now both expressed in euro. So the comparison here is possible. Okay, so now the question is domestic or foreign revenue higher? Well, of course, at the end, we should expect them to be equal. Why? Because of the arbitrage. Look, if there is a possibility to sell one currency and buy bonds in a different country and purchase a forward contract and still make money on the price differences in the two markets, so on a price difference in terms of interest rate, of course, then this possibility should be exploited by economic agents arbitraging. So what they're gonna do is they're gonna participate in arbitrage for as long as the two are equal to one another. And look what is happening then. Then we get that our expression for the revenue from United States bonds and Euro bonds are equal to one another. And look, L is present on both sides, so we can get rid out of it quite easily. And here we are getting covered interest rate parity. Look, this covered interest rate parity over here is simply uh, is simply what we get if we equalize revenues from both markets. And now look, just like before, maybe a better way to go about it would be using logarithms. So first, look, I can divide both sides by 1 plus IUSA. And now if I logarithmize both sides, and on one hand I use what we've learned today, so 1 plus x with small x is equal to logarithm of 1 plus x with small x is equal to x, we get logarithmic version of the covered interest rate parity. And we see here that the difference between logarithm of forward minus logarithm of spot exchange rate should be equal to the differences, approximately to the differences in interest rates. Now, why do we call it covered interest rate parity? Because look, this is because of the forward exchange rate over here. We've covered our exchange rates in the future, so we are 100 absolutely sure what is going to be our nominal earnings. So this is why we call it covered interest rate parity. Okay, so this equation that we've got over here is showing us how this covered interest rate parity should work. So we've got that F minus S is of course the difference between forward and spot price of dollars in terms of euros, right? So look, out of this we get that if forward is higher than spot, it means that markets expect depreciation of euro. How do we know this? You know, because now forward if forward is higher, it means that we need to pay more euros for $1, right? So we have expected depreciation of euro or expected appreciation of dollar. And it works, of course, in the opposite direction. If F is lower than S, so if spot rate is higher than forward, markets expect appreciation of euro. And look, right away we get another thing, like because we from the stance between the levels of interest rate, depending on which one is bigger, we can expect that we will have either either expected expected depreciation of euro or appreciation of dollar, or expected depreciation of euro of dollar or appreciation of euro. Okay, so look, it makes perfect sense. Like, of course, as long as everyone makes appropriate calculations, this condition should definitely hold. But let's just try it in practice. And look, we're gonna do it using the example on interest rates of Australia and USA. Okay, so look, we have data on forward exchange rates and spot exchange rates, interest rate in Australia and interest rate in United States. And look, this is basically the equation for covered interest rate parity. But look, this if we're gonna estimate it using OLS, what should we expect? Well, we should expect that alpha is exactly equal to zero, well, if the theory works perfectly, and secondly, that beta coefficient is going to be 1. Okay, so what data are we using? We are using monthly time series of interest rates for Australia and United States, as well as spot and 12 months forward exchange rate. So look, what I'm calculating here is the difference between spot exchange rate at time t and forward at time t for 12 months into the future. And this is the equation I'm actually estimating. Okay, but before we do so, let's just look at the data. Well, first thing we can notice is that changes in changes in forward exchange rates, as well as changes in spot exchange rates, very closely resemble each other. But of course, because they are very volatile, both of them, it's really hard to pinpoint where they are exactly equal to one another. But clearly, we see that they represent a very, very similar pattern. Okay, on the other hand, you see that that when it comes to interest rates, the volatility of 12 months interest rates in Australia and United States is way lower. But we still see some volatility, and that gives us a question. So if I'm going to examine the relationship between interest rates and volatility and exchange rates, wouldn't the volatility cloud out my entire picture here? And the answer here is no. Why? Because look, here we are having spot and forward exchange rates. So we are hoping that the volatility present in both is going to be eliminated by subtracting one from the other. And the similar thing should happen over here when it comes to interest rate. And actually, this is exactly what happens. Because look, once the equation is estimated, look what we see. We see that alpha is basically zero, not statistically different from zero. And in this case, actually, it's estimated upside down. So instead of 1.08, we should have like 0.94 something. But you see that this coefficient here is extremely close to 1. R square is almost 98%. And we see that the line we got is going through the origin. So definitely what we can say is that covered interest rate parity works very well. Okay, but now you might ask, but what about if I want to invest my money and I don't want to hedge. Uh, how will the problem that we were discussing just a couple minutes ago change? Okay, so let's go back to our issue. You have L euros, and you consider whether to invest it in Eurozone bonds or US Treasury bonds, assuming, of course, that. I Euro T, I added subscript T now for reason that will become obvious in a second, is that nominal interest rates on bonds in Eurozone at time T. IUSAT is the nominal interest rate on bonds in USA at time T. ST is a spot exchange rate at time T. So this is a price of $1 dollar in euros at time T. And E as T plus 1 is expected spot exchange rate at time T plus 1. Price, so this is a price of $1 dollar in euros. But look, if we're gonna make this thing work, well, there is only one way to do it. We're going to assume now that our agents are risk neutral. What does it mean that agents are risk neutral? They are only interested in expected value. So look, they are not. This is very unrealistic assumption because we usually assume that people are risk averse. You've been learning about it in various subjects. This is very good approximation of how we actually behave. But now, just for the purposes of this discussion, let's assume that agents are only interested in expected value. So basically, they're not they are not dismotivated or motivated by risk. So look, variance or standard deviation. So uh, how does actual outcomes deviate from mean is of no consequence to our risk neutral agent. Okay, and look, now we can use exactly the same we can use exactly the same reasoning as before to find a new revenue. And look, again, it turns out that look, the only thing we actually needed to change is F to SE. So expected exchange rate at time T plus 1. If we will go through the same transformations as before, what we're going to end up is the logarithmic version. So logarithm of expected exchange rate at time T plus 1 minus spot exchange rate at time T. Okay, and this is what we get. This is our uncovered interest rate parity condition. Now, this condition is kind of a useless one in terms of application. Why? Look, because we cannot properly measure expectations. You can ask people what they expect. You can make surveys. You can make use predictions of specialists. Usually, we average predictions of specialists to do so, but we can never get actually exact and, let's just say, unbiased and commonly accepted measure of expectations, which is of course a very big problem when it comes to generally macroeconomic problems and financial problems that predominantly rely on expected values in the future. So, in order for us to establish a framework within which we can actually test uncovered interest rate parity, we need to resort to one more assumption. This assumption is rational uh, expectations assumption. Look, if we if in rational expectations that you've been learning about in your macroeconomics classes, economic agents, of course, can make mistakes, but what they don't do is they don't repeat them in a systematic, biased way. What do I mean by that? We expect our agents to learn. If they were surprised by something, they're going to use this information in the future not to be surprised. Whether how much they are efficient in it, of course, it is a question that's actually sprung a lot papers in the literature, whether people actually behave like the hypothesis of rational expectations is met. But for now, let's assume that it is correct. Okay, and look, how does it work? It means that expected value of exchange rate at some time t plus 1 given omega t, omega is all available information set. So we take all the information that we've got in predicting this exchange rate in the future. But of course, we are predicting it uh, a period before, so of course we are prone to make some mistakes. And look, if everyone uses rational expectations, then FT, so forward exchange rate, should be equal to expected exchange rate. And look, with this, all this information at our disposal, we can actually make a testable equation. And because look, this is a spot exchange rate at time t plus 1 equals to some gamma 0 plus gamma 1 times forward at time t, but relating to this exchange rate t plus 1. So for example, this is on January 1st, 2020, exchange rate of US dollar to Australian dollar, and this is spot exchange rate 3 months from now. So on the first, of April, 2020, right? So we will be testing whether actually forward exchange rates are good predicators of spot exchange rates. But this is not enough. Look, we actually need to here test two hypotheses. And jointly testing those hypotheses is called simple efficiency hypothesis of markets. And basically it works like this. We want gamma 1 to be equal to exactly 1, and the covariance between error term that we've got over here and information set should be 0. Like if this condition is met, we see that we see no bias in errors, which means that our agents are not repeating the same mistakes. Okay, and look, we are doing this one more time for Australia, and what do we see over here? Look, the black line represents spot interest rate, and here we have forward 1 month from now, 2 months from now, 3 months from now, 6 months from now, and 1 year from now. And we see that again they are moving closer and closely together, but as expected, 1 year from now and 6 months from now are generally higher than others, and they actually deviate a lot from the spot exchange rates. So the further we are from the predicting point, so if I want to predict spot 1 year from now, it's going to be obviously harder than 1 month from now. And this is why those two lines are further than the other ones from the spot exchange rate. But look, we also see here interesting things this time about forward maturity structure, because we sometimes we are above, sometimes we are below. But this, of course, can be associated with the predictions, whether we are predicting appreciation or depreciation. Okay. Oh, so now let's go to the test. So look, what we see on this axis is 1 month from now spot exchange rate, and here we see spot exchange rate, and we put them on a graph. And look, we get that the slope of the line is almost 1. Basically, basically alpha is 0. Uh, so in this case, we see that uncovered interest rate parity holds really well. But look, if I increase my window to 2 months, we see that this coefficient drops, R square drops, while this coefficient increases. And we are getting a little bit worse predictions. And look, with each next consecutive month, we see that our predictions are getting worse and worse and worse. And because of that, we see that actually it is simply easier to predict exchange rates in the near future, to exchange rates a lot months from now. So, what can we say about uncovered interest rate parity? Well, it works definitely well in short periods of time, but when we need to predict value of some currency 3 or 4 or 6 or 1 year from now, the predictions are actually getting worse and worse. Okay, so now let's summarize everything that we said thus far. So look, if we assume arbitrage only, well, of course, and that the two bonds have the same general characteristics, we will get covered interest rate parity. So forward minus spot is approximately equal to differences in exchange rates. Now, if we add to arbitrage risk neutrality, we can right away get uncovered interest rate parity when expected appreciation or depreciation, of course, is equal to difference in interest rates, and from both of those, we will get that forward should be equal to expected exchange rate at time t. Finally, if we add rational expectations, so we are incorporating an information set, we can get testable uncovered interest rate parity hypothesis that we've been just testing right now. Okay, but as you might expect, in interest rate parity does not hold perfectly, and we actually saw that in our tested equation. Now, so I want to actually tell you about two main reasons why interest rate parity might not hold, and those are risk premium and transaction cost. In this case, maybe Euro area and United States are not the best examples, but I think you will be able to get the point. Look, first, uh, if I take uncovered interest rate parity condition, I can easily get to equation which expresses interest rate in Euro area as interest rate United States plus expected appreciation or depreciation And then we can add to these two components, risk premium and transaction costs. Look, of course, if making a transaction in other country is involving some additional costs, those costs will be preventing effective arbitrage, and the two interest rates will not be the same after the correction for expected appreciation. And the second thing is risk premium. If you have bonds from two countries, maybe not like United States and Euro area, but for example from Euro area and some some country with a dictatorship and let's just say civil war, then of course, as we said, there must be a risk premium, because if in order to attract capital, they need to compensate for the higher risk involved in allocating resources to their bonds. Okay, so I think this is everything about interest rate parity. In our next video, we're gonna be talking about exchange rate regimes. So thank you for your attention and see you in the next video.